the scene, it's your host TTP. We're flying high in the crypto sky, it's you and me. From Bitcoin rush to Ethereum, we traded all the coins. With the trading parody making that joyful noise. We got bots, we got plots, charts on the big screen. 3 comments to Wick Hunter with a trading machine. Laughing all the way to the bank, it's a fun parade. With every trade we made, watch how we get paid. TTP's got the formula, flipping coins like a spatula. In the crypto game with the vernacular, spectacular. From the morning to the night, we're streaming with the light, drunk and trading parallel. We'll teach you how to fight, dive into the charts. The RSI, liquidity at a glance, trends on the rise. We never leave it up to chance. All trading ganium, tools of the champion breed. With AI and math, we're planting the money seed. Laugh with us, trade with us, ain't no looking back. You're with the parrot now, leading the pack. Alpha profits, snap plus with the crypto law. TTP's on the mic and he's ready to soar. TTP's on the mic and he's ready to soar. TTP's got the formula, flipping coins like a spatula. In the crypto game with a vernacular, spectacular. From the morning to the night, we're streaming with the light. Join the trading parallel. We'll teach you how to fight, dive into the charts.
Hello guys, welcome to the Trading Parrot. I'm here with Matt from Bitcoin Magazine Pro. Today we're gonna do an analysis overall on Bitcoin. It's not just gonna be technical analysis, it's going to be actually data driven. We're gonna focus today a lot more on on-chain data. How are you, Matt, today?
I'm great. Thank you very much for having me. It's always a lot of fun and a great pleasure to be here. So yeah, I'm excited to get in. There's a lot of great data points and very interesting period of time right now. Obviously a lot of uncertainty, Bitcoin with a little bit of volatility. So yeah, I'm hopefully going to show you all some cool stuff and hopefully learn some cool stuff from you as well.
That's fantastic, and welcome everybody to the live stream. If you are just joining at the moment, you can write down some comments there. Of course, that helps to get more people in, and the louder you get is the better. So if you have as well questions, if you are wondering if the market is still healthy, if you want to look into a specific metric and you want the expert opinion coming from Matt, he is going to be here. We're going to aim for around an hour or so, going into different charts. After the live video is going live, we're going to put some timestamps as well if you want to skip to the different areas. So let's get started. I have a question for you to just to get us started, Matt. Are the weak hands shaking out? Do you think we lost a lot of short-term holders in this recent dip? Is that a bullish signal in your opinion?
It's one of those where it's there's good sides and bad sides to it. When we see a lot of long-term holders refusing to sell, that's obviously very good. It is indicative of conviction and some strength from long-term holders in the belief that price is going to continue to hopefully rally exponentially going forward. They're realizing the opportunity cost of taking profit right now. But on the contrary to that, it's also pretty healthy to see a lot of Bitcoin actually transition from these long-term holders to new market participants. The thing that really drives these big blow off top and massive exponential rallies is new capital inflows coming into the market. And unfortunately at the minute, we're not really seeing a huge amount of this big retail FOMO that we're all kind of anticipating. I mean, it's obvious to see if you look at the altcoin markets where everything's just bleeding out against Bitcoin, primarily retail driven markets. But even if you look to Bitcoin, it's mainly at the minute driven by large holders and kind of just a lack of meaningful on-chain activity, to be honest. So if we look at this chart here, which is the long-term holder supply, like I said, it's actually very bullish to see the long-term holder supply pretty much approaching new highs and continuing to rally aggressively to the upside as we're so close to new all-time highs. Usually at this point in a cycle, we're seeing big drop-offs in this long-term holder supply. Like I said, it's a very natural progression of a bull cycle to see Bitcoin transferring from long experienced hands into new market participants. But now it's kind of the opposite. We're seeing Bitcoin rallying as the long-term holder supply increasing. The only other time that's really comparable to this is this double top peak we saw in 2021, which a lot of people are maybe saying, maybe now we're looking like we're seeing a double top in price action, but we do have some data that maybe doesn't really go along with that. So yeah, like I said, it's an interesting point at the minute where we're not seeing new capital coming in, we're seeing profit taking really decreasing, and a lot of the actual activity on chain is actually coming from these big ETF institutional buyers and corporations like Strategy buying billions of dollars of Bitcoin. It's amazing how much Bitcoin as a network, as an asset class has changed in just a few years, going from just purely retail driven into more leverage and speculation in the previous cycle, into this cycle being almost primarily and solely driven by big institutional players.
Actually, I have a question about that because I'm starting to hear in social media a little bit more often people referring at the ETFs as retail. Because when we started with the ETF, it was advertised to us as institutional, exposure, like BlackRock and all of that is institutions. But how much of that is really representing retail? Because retail is using ETFs to buy, and sometimes when we are seeing these rallies, we see new inflows, and I'm constantly thinking, is that really institutions doing that? Because that smells a bit as if it was retail. That's the typical behavior of retail.
Of course, and it's a great question, and it's a little bit of a misconception, and I maybe alluded to that a little bit as well. The ETFs aren't directly institutions buying. Of course, they will make up a portion of this. I think there's estimates of around 30% of this ETF activity is actually from institutions. So even though we are seeing hundreds of millions coming in from these, a vast majority of them are probably just high net worth retail participants who are just buying, and BlackRock are buying on their behalf. However, one thing that is definitely undeniable is the holdings in publicly listed companies. And the amount of Bitcoin currently in these treasuries is 823,000 Bitcoin, which actually far exceeds the net inflows we've seen in the ETFs since their launch last year. So even though, like I said, there's a little bit of a misconception that the ETF inflows is all institutional money, we have still seen over $86 billion of genuine, provable institutional money flowing into the market. So again, it's one of those, there's a little bit of a gray area, and on-chain data is definitely evolving, whereas a few years ago it was pretty much cut and paste. You knew exactly what was happening on chain. You knew every activity, every transaction was pretty much by a retail client, and it wasn't very opaque. Whereas now it's getting a little bit into gray areas. Like I said, now that we're seeing a lot of off-chain activity, a lot of derivatives now are becoming more and more popular. A lot of other Bitcoin-related products and strategies accumulation, of course. So it is getting a little bit more complex. But in general, the market is still very much driven by retail participants. We can see a huge amount of on-chain activity is still the market's retail participants who have been holding Bitcoin for extended periods of time, not necessarily all driven by people or institutions who've just bought in the past few months or year. So I think things still look very healthy, even though it is getting a little bit more difficult to really see clearly what's happening.
Cool. And you just touched base on off-chain and the derivatives and all of that. And we've seen this cycle, how we are affecting the actual Bitcoin network in terms of new participants and in terms of transactions and new people holding for the first time and adding to the wallets. All of these metrics are bleeding like as if we were in a bear market. It's kind of an anomaly that we are at all-time highs or slightly below it. And all those metrics are looking like deep in the bear market. And on the other side, we just recently had a hash ribbon buy signal, a confirmation on the weekly, and on the daily, the hash rate has been fluctuating. So there is these two forces, like obviously the hash rate going up, the buy signal from hash ribbons is very bullish. But on the other side, everything that reflects activity that is the main source of income for the miners, and definitely their motivation to stay in the ecosystem is kind of bleeding at levels of bear market. What's your take on the combination of hash rate and activity in the network at the moment? You think is something to worry about?
Well, it's a great question. I actually made a video on this last week. I'm not sure if you've seen it. It was a lot of fun to make. So I think there's two sides to this. So the active address is decreasing, like you can see on the chart here, definitely doesn't look ideal. And this reduction in on-chain activity is reducing the miner revenue in terms of fees to actually some of the lowest levels we've seen in over a decade. So that's obviously not ideal, but I think this is a pretty natural progression of Bitcoin, at least for the time being. No one really wants to be the Bitcoin pizza guy who spent 10,000 Bitcoin on 2 pizzas. And of course, we're a little bit past that. It's not going to be like that. But I mean, even a few years ago, I remember making my first Bitcoin purchases of just a few stickers. And now I have to calculate how much I spent on stickers, and it was hundreds of dollars. So I think Bitcoin, as it grows as an asset class, as we go from this speculative asset of just a few $1 billion market cap to now a multi-trillion-dollar asset, people have realized that Bitcoin is around to stay, and to actually sell now or spend your Bitcoin seems a little short-sighted. A lot of people are now holding for the future and seeing it maybe as a portfolio asset, where rather than buying, 1 or 2 Bitcoin here and there, they're thinking, I need to have 5, 10, 20% of my wealth held in Bitcoin. Now that really changes the investor dynamics and the reluctance to really sell. So is this bearish for Bitcoin miners? Potentially going forward, I think given the fact that 98, 99% of the miner revenue is from the block reward anyway, it's not an immediate concern, but potentially going forward, it may be a concern. And you mentioned the bullishness that we've actually seen in the hash rate. In fact, over the past few days, we've actually seen a massive drop off in the hash rate, where this has decreased quite noticeably over the past few days. Now, again, I don't think we need to take it too much of a bearish signal that we've had a little bit of a dip in this hash rate just over the past few days. Miners typically like to see volatility. They like to see Bitcoin having these big rallies to the upside or even rallies to the downside. At least they can then gauge activity a little bit more. But the fact that we've kind of been stagnant, I mean, since 2024 November, we've been above 100K, and I obviously know we've had a little bit of retracement since then, but this cycle has been really different, where we've had these long periods of boring, choppy consolidation, reprice action, big expansion, big moves to the upside or even the downside, and then again multiple months of just sideways choppy consolidation. And this is pretty boring, and this leads to not many people using Bitcoin because they're just seeing it as this stable coin essentially, which isn't really fluctuating in price too much. There's not really much opportunity when volatility is diminishing so much. So of course there's a reduction in on-chain activity, which would negatively impact miner revenue. But like I said, I think in general, if you zoom out, this definitely doesn't look bearish. We've seen this go almost exponentially to new all-time highs continuously, even throughout the previous bear cycle. So I think just this little blip isn't necessarily an immediate bearish signal, but like I said, the dynamics of miner revenue and fees continuing to diminish as less and less people are using Bitcoin on-chain doesn't look ideal for the future. I mean, I'm talking 10, 20 plus years into the future, but by that point, Bitcoin may have stabilized at, say, a $20 trillion asset, flipped gold, and at that point, maybe we are using it for on-chain activity, maybe we are using it for large international settlements, and at that point, the dynamics again change for Bitcoin, like they have done every single cycle for since the inception of Bitcoin.
Cool. I'm actually seeing, let me share my screen, the capitulation signal. If we were to get one, it's getting quite close to confirm. Let me see, Firefox. This one in here. There you go. So you can see I've got the same hash rate, but this is with the moving average coming from the hash ribbon. Some people are saying in the comments the hash ribbon doesn't work anymore. Do you subscribe to that? You think the hash ribbon is an indicator we should ignore, or you think it's still valid? It has had in the recent time a few signals that kind of faked out. For example, in here we have this capitulation, then we have the buy. Actually, where was it? It was a little while ago that we have one that had a big, am I in the daily? Yep. So this buy here went down 15% further. This buy was triggered around here, and we went down 10%. So there is some drawdown, but I wouldn't necessarily personally say that is completely broken. What's your take on the hash ribbon indicator? Do you use it?
Yeah, so I like to use it. Charles Edwards, the creator, is a great analyst in the space, and I have a lot of respect for him. And he has a lot of great metrics that I think are really worth the time to look into and acknowledge as we move throughout the cycle. And it's one of those where, from a personal perspective, I can see how the effectiveness of the hash ribbons is going to diminish over time. I mean, it's only natural, especially as the hash rate continues to kind of move up exponentially like we could see through a bear cycle. It doesn't have this one-to-one correlation like we've previously seen. Bitcoin previously was mined almost exclusively by individual participants who were just mining on their own little computer rigs at home and had a few graphics cards or something, whereas now these are multi-million-dollar mega operations with shareholders and big balance sheets and huge costs that they have to factor in. So I think that these are planning not for the next few days, weeks or months. These are miners planning for the next few years. So this is why we're not seeing these huge swings in the hash rate like we've historically done. So maybe the effectiveness of the hash ribbons is going to diminish because of that. But at the same time, this is still kind of personal perspective. If you actually look at the numbers behind the hash ribbon's effectiveness, they do still kind of work. And I'm one of these where if the data is still pointing towards it working, then we don't necessarily have to immediately discredit that. Another popular discussion point is the 4-year cycle potentially ending. A lot of people say institutions are here now, the 4-year cycle's over, it's going to be something that acts completely different, maybe following a traditional 8-year business cycle or something like that. Until we see evidence of that happening, we have to use the 4-year cycle as our base case. We can predict, we can forecast, we can say things are changing, but realistically every single cycle has been unique, and the more things change, the more they stay the same. Institutional participants are still prone to the human psychology that impacts every single investor, and the patterns that we're seeing in price action, again, aren't too dissimilar to the period of time we've seen historically throughout Bitcoin. So I don't think we can say this isn't going to work or this is going to work purely because of what we anticipate will happen. I'm definitely more of the mindset of we need to react to the data when it actually comes in rather than try and predict the future.
Yeah, makes sense. And I'm quite curious because we haven't chat in a while. What are the top aspects or the top things that are driving your bullishness at the moment? Let's create a role-playing game. Let's assume that right now you have all your wealth on Bitcoin. What will be your 3 reasons to continue holding all your wealth in Bitcoin?
Good question. Tough question. Right into it, I'll just share some data points here. So, I mean, I'm someone who's incredibly bullish on Bitcoin, but I do get a little bit of slack because I quite publicly state that when the time comes, I will be taking some profit on my Bitcoin with the goal of accumulating more Bitcoin. And I know everyone says you should never sell your Bitcoin, and Saylor says the only strategy is to hold forever, that type of thing. I don't necessarily agree with that. I don't necessarily buy into that. I am going to always hold a portion of Bitcoin, but realistically, I can see there are periods of time where the Bitcoin market is maybe a little bit overextended to the upside, and at least reducing your averaging into the market and saving up that capital to average in when the market's a little bit of a discount seems to make some sense to me. But one of the metrics that I really love is the value days destroyed, because my best investing comes when I just drop all of my own personal biases, drop my own opinions, and just essentially copy what the most profitable, experienced, largest market participants are doing. And this value days destroyed really outlines that. So this is looking at a metric called the coin days destroyed. So for any of the metrics on Bitcoin Magazine Pro, if you just scroll down, it gives you a full analysis and breakdown of how these are actually calculated. But essentially the coin days destroyed weights transactions on chain by the amount of Bitcoin being transacted and the amount of time it was held. So if I held 1 Bitcoin for 100 days, for example, and then sold it, I would add 100 coin days destroyed. Whereas if I held 0.1 for 1,000 days, it would be the same. So those that have been holding Bitcoin for a huge period of time and a huge amount of Bitcoin, when they sell, it usually has a big influence on the market. And that's when we get these big red spikes in the value days destroyed metric. And we can see it doesn't necessarily indicate a perfect cycle peak. We can see in 2017, we actually had multiple peaks of this before we hit the final top of that bull market. But it does give us a general indication of the future outlook of the market's biggest and most influential participants. And if they're looking to offload, if they're selling, they're taking profit, usually it's not a bad time to just copy them. There's no shame in copying what the most profitable people in the market do. Yet when this is green down here, it indicates the complete opposite. It indicates that the market's biggest, most experienced, largest participants do not want to sell. They see that Bitcoin is going to go considerably higher, and they see that they can increase their profit potential by holding on for a little bit longer. So if you just look at this cycle in isolation, you can see every period where this was green, indicating that there's very little long-term large profit taking going on. We can see this was a great opportunity to accumulate Bitcoin. Even after the rallies, we get every little retracement. Just before we ran up to new all-time highs of 100K, this flashed green just as everyone was getting bearish, everyone was calling for 30K and the bull cycle was over. This was the most opportune moment to actually accumulate Bitcoin. And again, once we were above 100K, and even recently as we retested and broke above into new all-time highs, this was increasing quite rapidly, indicating again, people are beginning to take some profit. And all the Bitcoin price is influenced by is supply and demand economics. If people are selling and not enough people are buying, the price is going to be reflected in that. And what we can see now is this is actually rapidly decreasing again. So just as everyone starts to get bearish again, as soon as we retested the short-term holder realized price just yesterday, which is about 98.5K, as soon as we retested that, and as soon as we get everyone saying, now's the time to be bearish, this is the start of World War III, we're going to hit 70K again, the bull cycle's over, we've hit a double top. You can just look at the data and say, it's not really pointing towards that. I try and just get rid of all of the noise, all personal opinion, look at the data points. And for me, this is one of the great metrics that shows that now is a great time to just be accumulating or at least holding onto your Bitcoin without taking too much substantial profit. Now, you asked for 3 charts. I've shown...
Before you go to the next one, I actually want to comment on this one in particular because it's actually reflecting the state of the art of many other indicators. If you zoom out and you show just, again, the full history, on 2014, we have 2 peaks in red, right? You can show them. And what I see there is that there is a bearish divergence of the price against the BDD because the second peak is lower than the first one, right? Counting just the red ones. So that is a very divergence because the price couldn't manage, the BDD couldn't manage to also put a new high. And when you get the first bearish divergence on the BDD, I could say that in that cycle, that is the top. And then going forward into 2018, you get 2 large red peaks. The first peak occurs at around less than 10K, and then the final peak at 20K. And you get the same effect. You get that bearish divergence against those 2 peaks of the price versus the 2 peaks of red. And then if you go to 2021, which has its own anomalies thanks to the COVID and all of that, and we couldn't get a blow off top, so we cannot apply the same perspective. But what we can say is that we got the first peak on the first peak of the price, and then the second one, there was a higher high on the price, 69K, and we have not enough BDD to produce a red peak, but we have a higher high still. So the pattern is there, but it's a little bit broken. In this cycle, what I'm seeing is that we already put 1 red and that we still cannot manage to put a second red. And instead of that, we continue to put lower highs. So we got 1, 2, and this is the 3rd lower high. So I think that that puts a lot of pressure in the cycle, in my opinion. That's my takeaway number 1. And my takeaway number 2 is that this is not the only indicator that is behaving in this way, this particular cycle, that is full of anomalies thanks to the institutions, the retail not being present, the time that is taking for the global liquidity injections to get in the market so people have something in their pockets to put into Bitcoin, which doesn't seem to be yet the case. If you check for people searching for Bitcoin and all of that, all the indicators of retail are showing that they're not present. They're just gambling a little bit here and there with futures, but spot buying, not necessarily the case. So that is something worrying to me, if you ask me. That's just a point against this BDD that I currently have.
No, 100%. And it's one of these where I definitely don't think in black and white. I mean, of course, I'm bullish bias. I think Bitcoin's going to continue to increase, and we'll cover some more points on that. It's not like I focus on just the one chart. I try and look for confluence throughout multiple different metrics and different perspectives, try and gain a more unbiased view on the market. But of course, it's a possibility. We could have already topped for this cycle. We could now see Bitcoin continue to set lower highs, begin our bear cycle, and go to lows of, I don't know, 50, 60K, even lower potentially. But I like to think in terms of probabilities. And I think the chances of us going up far outweigh the chances of us going down right now. And the asymmetric bet to the upside means that even if there is a probability of us going down, which there always is, may that be 10, 20, 30%, I'm not sure exactly, but I still think the risk to reward in taking the long side on Bitcoin far outweighs that downside risk of not accumulating or taking profit now in anticipation of further downside. We're talking about an asset that's gone from a fraction of a penny to over $100,000, and people are constantly looking for what the downside's going to be, when if you'd have held There's 99.9% of all of Bitcoin's history where if you'd have held today, you'd have been in a profit. So if you have a longer time frame horizon, of course, it's easier to be bullish than it is to be bearish, and it pays a lot more to be bullish than it pays to be bearish. But of course, there's the possibility that that can happen, but we have a few other charts that maybe lead me to believe that this isn't going to be a double top like we'd already seen in 2021, if you'd like me to show.
Yeah, let's go for it.
So you already mentioned it, but the global M2 money supply. So I think this is a great metric and one that is really going to have an influence on the Bitcoin price action like it always has. This is the dry powder, the capital on the sidelines that can pour into Bitcoin. And it usually does take a little bit of time to trickle down. I think a lot of people have analyzed that this cycle and found about a 10-week lag in the global M2 money increasing before we actually see the Bitcoin price increase. But if we look on a day-by-day basis, it kind of misses the forest for the trees. If you just zoom out, and rather than looking at the pure global M2 chart, which you can see is typically always on a big uptrend, I like to look at the year-on-year chart, which shows us the acceleration or deceleration in the expansion or contraction. And what you can see is the correlation to Bitcoin is near 1-to-1. It's not perfect, of course. Bitcoin typically peaks before M2 money supply peaks. So a lot of people thinking that Bitcoin is lagging behind the M2. It maybe does for a majority of the bull cycle, but Bitcoin's definitely going to top out before the M2 money supply does. What we can see is this is very much in a general uptrend. And Bitcoin has actually been lagging behind this a little bit recently, which makes me think that, of course, the global uncertainty, the lack of retail interest is, of course, playing its part and has limited our upside potential. But in general, this is very much on a strong uptrend. Whereas if you look to the previous peak, that 2021 double top, this was very much in a downwards spiral. This was not necessarily contracting, but the rate of acceleration had massively diminished. And the same is true for the 2014 peak. We don't actually have the data on here, but if you go to our trading view indicator, you can see the same. We did get that double peak, but the global M2 money supply had already started rounding off before that happens. And alongside the global M2, I also like to look at the US dollar strength index. Now, again, this is looking at the essential purchasing power of the US dollar weighted against a basket of other fiat currencies. And what we can see is there is an inverse correlation between these metrics. So as the US dollar strength massively increases, we typically see Bitcoin bear cycles. And as this is decreasing, we typically see Bitcoin bull markets. Now, in the previous cycle, we had this double top where the Bitcoin price made a slightly higher high, but granted, it was an all-time high afterwards, after many metrics had already pointed out that we may be peaking. Now, if you look at something like the US dollar strength index, this was already rapidly increasing as this high was set. I think this high, it's a really peculiar cycle, the previous cycle, primarily driven by potential leverage plays from big players like FTX, who essentially went bankrupt by trading paper Bitcoin, and it was a very odd cycle. A lot of the on-chain activity pointed towards this first peak of $60,000 to be the actual top, and then the second one, again, during, post-COVID with all the stimulus, it was a little bit harder to gauge. But if we look at the data surrounding it, the US dollar strength index, M2, and some other on-chain data points, we can see that many metrics were pointing towards this not being the double top. The market had already peaked out, whereas in this cycle, this is continuing to decline. If this was the double top, I'd have anticipated this to already be starting to move back to the upside. Same as M2, I'd have already anticipated M2 to start curling back to the downside. But we're seeing more and more liquidity injections. We're seeing fiat currencies continuing to diminish in their purchasing power, alongside long-term holders not wanting to sell, alongside institutions, albeit not entirely institutions in the ETFs, but Bitcoin treasury companies buying billions of dollars of Bitcoin. From my perspective, it's way more likely that we see significant upside before significant downside in the remainder of this cycle.
Makes sense. Do you have something similar against gold? Do you have like some sort of chart that shows you the relation between?
All we have is the gold versus Bitcoin correlation. And we can see the correlation between Bitcoin and gold fluctuates between positive and negative. Bitcoin is way more correlated to the S&P, but in terms of the US dollar strength index, we don't actually have those charts for gold.
Yeah, I was just curious, what's your take on gold new all-time high, and if you think that we are due for new all-time highs on gold, or if you see it as still as a competition against Bitcoin, or just becoming part of the same asset class of safe haven?
It's a very interesting topic, and kind of back to the ETFs. I think Bitcoin isn't quite there as this safe haven hedge asset yet. However, we are seeing some really promising indications. So We've already mentioned the ETFs, so I won't hang around on them too long. I definitely don't think Bitcoin is this digital gold. Like I've said, we're just way too correlated to the S&P 500. Until our market cap massively increases, we are still going to be this more risk-on and speculative asset class. However, over the past couple weeks, during all this period of uncertainty, we had 2 consecutive weeks of huge positive inflows, positive net inflows for the Bitcoin ETFs. And now we've already discussed this in length, but this isn't necessarily completely institutions, but about 30% of this at least will be made up of institutions purchasing through these ETFs. Now, in times of uncertainty, you wouldn't think a more risk-on speculative asset like Bitcoin would be the play. However, we've seen over $2.5 billion of inflows as Bitcoin has been having a little bit of a drawdown period, a little bit of volatility and uncertainty, which really does give me a little bit of confidence that people are starting to see Bitcoin as this more safe haven asset. And maybe at some point we will see a decoupling where we can act truly as an independent asset and aren't just tied to the US economy and equities. But I just don't think we're there quite yet. It's one of those processes which takes a real long period of time to get people's mindset to actually transition from this, internet magic money to this safe haven, stable asset that is almost a necessity within people's portfolios.
Yeah. I was thinking as you're showing this chart that one of the downsides of the spot ETFs is that we really cannot see what's going on the blockchain when it comes to everything that is owned by these ETFs. And as a consequence of that, we don't know if it's retail or if it's institutions, if it's large holders or whatever. We just see inflows. We just see the overall amount, and they wouldn't, as far as I know, there's no one telling us that BlackRock, the proportion of all the pie that they have, X% belongs to retail and this other half belongs to large holders. And that's a big downside, because in the previous cycle, we were accounting for that. We knew that proportion, and we were making decisions based on that, data-driven decisions, and saying, okay, we got too much retail now. Oh, we got too much of investors, large whales, and they are depositing, withdrawing. And we were kind of front-running those things, of course, using the some logic behind. But now all we know is this all-time high of cumulative inflows that we currently see on Bitcoin. Ethereum is kind of catching up with that. But I seriously want to see who are they and how much is that. It's a lot more difficult. Of course, if everything eventually moves into tokenized world, and then stocks and everything was just part of a blockchain wallet, I don't think we're gonna get to full transparency. But the more we get into that, the more analysis we can do.
Yeah, 100%. My counter argument for that would be, which is a valid point, and a lot of people are seemingly getting a little concerned at the potential future accuracy of on-chain data due to the obscurification of activity and transactions and whatnot. My counter argument for that would be, in previous cycles, we've seen 70 to 80% of all transactions happening on centralized exchanges like Binance, like Bybit, FTX pre-collapse. They weren't transactions, anyone who deposited on an exchange and were buying and selling, that's not occurring on-chain either. We don't necessarily need to see 100% of on-chain activity to really get an understanding of what's happening. In previous cycles, we only needed 10, 20% of people who are holding Bitcoin in cold wallets to actually move it to really get a good idea of what's happening on-chain. When you do a census survey through a country, you don't have to interview every single person who lives there, what TV station they watch. You ask 10, 20,000 people and you can get a general understanding of what the nation's doing. So I do still think that there is a lot of viability for this data. And we also need to acknowledge that through the ETFs, through corporate treasuries, this is about 2 million Bitcoin, which is still only about 10% of the circulating supply. A vast majority of Bitcoin is still owned by people like you and myself, and any transaction we do is very much still available to see on the blockchain. So I still think it's going to be very effective. But going back to previously what you said about 3 metrics that do give me some confidence that I will be watching, if I can just screen share, because we do have some great metrics which I think also take into account this shift in market dynamics. So if I just share this one here. So the MVRV Z-score is one of the most popular metrics we have on site, and that is the market value to realized value. So it takes into account the realized price, which is similar to the short-term holder realized price, whereas this is just taking into account new market participants. The realized price is taking into account the average accumulation price of all Bitcoin on the network. When we look at the MVRV score, I will just bring it up so you can see for reference. Again, there's this argument of diminishing peaks. We're seeing each top in the MVRV actually less than it was in the previous cycle. Now, this does concern a lot of people, and rightfully so. We are seeing the Bitcoin market changing, and we're likely to see the on-chain data and metrics we rely on change because of that. However, if we look at something like this, which is the exact same as the MVRV score, but rather than looking on the full history of Bitcoin, we're looking on a 2-year rolling basis to account for these changes, we can see it still provides a huge amount of alpha and accuracy to when it comes to helping to time your investment decisions. So if we just look at the standard MVRV score, again, we can look at the peaks between 2017 and 2021, and people would say, oh, well, maybe this peak we only reach a 4 or a 5, or maybe not even that high. But when you're changing the data to adapt for the changing market conditions, when it's evolving over a rolling period, so even if a vast majority of Bitcoin is transacted off-chain in the future, and it's all in these ETFs and it's all being gobbled up by corporations, even if there's only a few Bitcoin being transacted, as long as the data can adapt for that and actually take into account the amount of Bitcoin that is being moved, again, we can still get a very good idea. So the MVRV score 2-year rolling gives me a lot of confidence that we still have a huge amount of upside potential to go in this cycle, as it's accounting for these changing dynamics and as it still has a huge amount of upside potential.
Nice. And this is another one of those indicators that is showing the diminishing peaks. But well, you say that you're not worried. So does that mean that you're expecting still to get a higher high on the MVRV? Is that possible?
It's impossible to predict. But is a higher high possible? Of course. If we look at, I don't know if you can see when I draw on my screen. If I make a drawing here, is that visible on the stream?
Not yet.
No. Okay. You're not going to be able to see it. So if we look at the high we set here, we can see that this is actually beneath the peaks we set on this metric in the 2017 cycle, as the Bitcoin price was around $2,000. Now we did a 10x from there, and we saw a much higher peak in this score. Of course, there's the chance that we can come up. We don't see as high a high. We have seen 2 lower highs in this cycle already. But like I said, looking at the supply and demand economics of the network, if we don't see a big black swan event, if we don't see World War III and the S&P 500 absolutely cratering, which again, everyone can speculate, everyone can say the economy's not in a great place, but the S&P 500 and asset prices aren't necessarily reflective of the strength of an economy. They're reflective of the demand for assets that provide some return. And we can see the S&P 500, even in spite of the uncertainty, is continuing to climb higher. All of the on-chain data seems to support that Bitcoin can be primed for a significantly higher move, especially if we can get some retail inflows. So I do anticipate us maybe not to make a high as 4 or 5 or as high as the peaks in previous cycles, but I'd still anticipate us to get above the previous peaks we've set in this cycle towards a value of around 3, maybe towards 4.
Yeah. Well, personally, leaving aside all the data and just doing a kind of finger in the air speculation of what could happen during this cycle, I thought about 2017 as the perfect cycle. That is just parabolic. They're huge retracement, but they are almost unnoticeable if you look far away from the price. It feels like it's perfect. Of course, if you were there within that cycle, you will think, okay, this is the top. We are at 5,000. That's the top. But not. Then it went to 10,000, and there's some retracement. But from far away, it feels like you went straight to 20,000. And all indicators that became really famous, like the the Pi cycle, and there's a bunch of them, bull market support band, and I think they're mostly from that era because it was so perfect. So people started putting MAs, putting different indicators on the chart and saying, okay, this is the way a cycle behaves. We get a blow of top, we get this, we get that. And Plan B came up with all his things, and then they came to 2021 to apply all of that. In 2021, we have kind of a disaster in the beginning. Prior to halving, we have COVID, right? And then we have a decline, massive decline, a double bottom. And then we started going and rallying into 2021. In 2021, everybody was shouting, where is the blow of top? Well, where is the blow of top? Plan B, where is all of these theories and stuff, 150K must come, and blah, 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 blah. It never came, right? And so I started thinking, we have this trio of cycles. We have the perfect one. We have the one that is hijacked in the beginning. And when we were approaching this cycle, one thing I told myself, what if this is the cycle that we get the big surprise at the end of the cycle? You know, the big surprise, I call it like some sort of black swan event, or in that proportion. And as I remember in my stream with Benjamin Cowen, I asked him the same. What do you think about a cycle now where we get the shit hitting the fan at the end of the cycle? How is the chart going to look like if we had something like that? My way of speculating of that is, if we get something big in the middle of 2025, I will expect a retracement that goes deep enough to convince everybody that the cycle is gone. And suddenly we get a huge move up out of nothing with money printing. And that is the actual peak. But at that point, most of the people are already burned out. I tend to think that that could be the case, but it's starting to rhyme too much with what we got in 2021. So I need to push myself to be creative on how will it play out, because I'm kind of subscribed to the idea that something is going to happen, you know, with all the inflation that has been so sustained, the rate cuts that are being pushed back month by month, and all of that. And well, and we got a lot of fun going on in the news these days. So it's not guaranteed, of course, but how would you think that will reshape the end of the topping of the market? Do you think that that's straight down, or there's a surprise comeback, or a lower high? How do you see it, hypothetically speaking?
Okay, so we're into personal interpretation territory here. So I will say, back on what I said before, it's better to react than to predict, but that's not as fun. So I will give my own personal opinion on this. So I think Bitcoin's traditional 4-year cycles, which of course everyone looks towards 2016, 2017 is the perfect cycle, especially post-halving, where we had this, you know, year of recovery, year of big bull market, year of drawdown, however it works out. I don't think that's necessarily going to play out anymore. I think the previous 4-year cycles were driven very much by the halving events, just because of the supply and demand economics of that. Whereas now 94, 96% of the circulating supply of Bitcoin that will ever exist are already in circulation. So of course the inflation rate is going to continue to be decreased by 50%, but the influence that actually has on the daily issuance of new Bitcoin is massively reduced, unless we start doubling in price action every 4 years, which at some point were worth quintillions of dollars in a very short space of time. So I actually think the Bitcoin cycles going forward are going to look a little different than what we've historically seen, especially with the influence of the institutional inflows. I think we're not going to see these big 60, 70, 80% retracement that we've historically seen. I think they're going to be very much muted to the downside, where we're going to potentially, like you said, see mini bear markets that last 6 months and we get 30, 40, maybe 50% down, enough for everyone to think, right, well, here we go, here's the 60, 70, 80% 2-yearer, and then we can maybe recover, and then we'll get what looks like it could be the start of a blow off top, where we're going to get these big moves to the upside, everyone starts piling in, and then it again kind of turns over, just to frustrate people, just to kind of give this not very clear, not very obvious big cycle that may play out over the course of 8 or 12 years rather than these 4-year ones, which is a much more muted cycle. It's kind of similar to what we've seen now, where we see this big step up or this big step down, loads of choppy consolidation, really boring price action before it goes up. But I actually do think that this is slightly more healthy and sustainable for higher prices. Again, it's into kind of guesswork territory here to assume that there's going to be lengthening cycles. But if this cycle can step up and we get more gradual, more sustainable inflows into the market, everyone's expectations of reset. Suddenly $100,000 seems normal. If we'd have ran up from $30,000 to $100,000 in 2 weeks, everyone would be selling. Suddenly we're going to have this big retracement. The faster we go up, the faster we can come down. Whereas if we can kind of reset expectations, maybe in the next few months we move up to between 120, 130K, everyone gets excited again, everyone starts longing on leverage. Suddenly the market has a little bit of retracement, a 10, 20% retracement like we've just seen recently. Everyone gets a little bit upset again, starts selling, here's the bear market, and suddenly the institutions are accumulating some discounted BTC. Of course it's frustrating, of course it's not as exciting, but I actually do think that that could be a lot more sustainable and see Bitcoin going to substantially higher prices in the coming years.
Since this is a community that is quite weighted towards swing traders and daily traders, nowadays, are you doing your own manual trading as well, or just the holding in with the vision in the long term for yourself?
I dabble. So I like to say I split my capital into different portions. I have a never touch allocation. So my pension is in Bitcoin. It has been since I think 2018. So I'm going to have to be holding that for the next 30 years. So that's going to be an interesting hold to see how that plays out. I then obviously earn some money, some in fiat currency, some in cryptocurrency, and I try and strategically dollar cost average in. So rather than just blindly dollar cost averaging, I wait until we're at a bit of a more favorable risk to reward region once I see a little bit of confluence in the market. So a few months ago when we were at about $75,000 to $80,000, of course I didn't catch the exact bottom, but I was scaling in a little bit more aggressively because I knew once we first surpassed 110K, everything was looking a little bit overheated. We needed a little bit of a cool off. So any capital that I was earning, I was putting to a side and waiting for Bitcoin to be a little bit more favorable, just so I can accumulate more. So then once I scale in, again, I can just sit back, enjoy that, and dollar cost average in without too much thought, just trying to do it a little bit more strategically. But then I do have a small allocation, which I like to be a little bit more active in the market. I'm taking into account more short-term metrics, more derivatives data, more technical data rather than the on-chain stuff, which can sometimes take weeks or months to really form a clear and obvious pattern. And then this way, it just keeps me interested, it keeps me excited. I just enjoy doing it really. And it allows me to more frequently kind of speculate on the more intra-cycle price movements of Bitcoin. So I still try and take a very automated-like approach. I do automate a lot of the decisions that I make, but even the manual trades I make, I almost try and act like a robot myself, where I'll have a checklist of criteria. Is this confluence matching? Is these both pointing towards? Is the favorable risk reward still very much in my favor? And then try and take a very unbiased, unemotional view throughout the trade as well. At what point am I managing it? Am I trying to reduce my losses at this point? Because I think that the kind of thesis behind the trade when I took it has kind of gone against me. At that point, I'm limiting downside. Or is now the market kind of moving even more bullishly than I thought? Well, now I can kind of double down and try and anticipate even more returns for that trade. But it's not something that I'm great at. It's not something that I spend a lot of time doing. I'm definitely not one of these scalpers trading intraday, just trying to get 100 different trades out. It's one of these every few weeks. I'm very happy to be patient and let the market come to me until the point where I just feel like an opportunity is too good to pass up on. So I definitely consider myself more of a swing trader when it comes to that portion of my capital. And it's something I enjoy doing, even if it's not something that I personally think I'm amazing at or excel at.
One of the indicators I'm now using, I've been using for maybe over a year, is the cross-buy cross-B ratio.
Yep.
Is that? Yep. I really love that indicator. I actually wanted, if you guys don't know, you are in front of the author of the indicator. I didn't know that you wrote that indicator, and I've been praising it for a long time because it's to do with volatility. It's an oscillator, and it works for all the assets. The only thing that I've been missing is to get alerts on that. But I found a way to get alerts out of it from TradingView, and now I get alerts from it on different time frames, and it really helps me. Not necessarily to. I don't use it to automate, but I use it to poke on my shoulder. Hey! There's something really sexy crossing the street. You should look. That kind of indicator. It works really well for that.
Yeah, so I've just got it up on the screen here. So I'm very much of the mindset that you don't want to overfit. So just very briefly going back to the metric you mentioned previously, the pi cycle top. This looks at two different moving averages, and when the faster moving average, the 111-day, crosses above the 350-day multiplied by 2. Historically, it's marked the cycle peaks for Bitcoin. Now, it surprised everyone by working in the previous cycle, but to be honest, like this model, like every single model, at some point it's going to break. It's not going to work anymore. I won't necessarily say it's overfitted, but it's very much assuming that conditions are going to continue to remain similar going forward, which these are markets we have no idea what's going to happen going forward. Whereas I like to try and make something that's going to work regardless of market conditions, regardless of ticker or time frame. So as you said, this is based on the slope of the 30-day moving average, and it accounts for the current volatility of the market. So it doesn't matter exactly what you put it on. But Again, I wouldn't use this on its own. I wouldn't use this just individually to make any trade decisions. But like I said before, we're trying to look for confluence. So as we were coming up here towards the $73,000, $74,000 peak post ETF announcement, alongside that, if we look at something like the realized cap hodl waves and say, yeah, we're getting a little bit overheated here. We look at the value days destroyed. We're seeing some long-term profit taking. We look at the funding rates, which I don't have open, but then we can see a lot of people are excessively longing. All of these are kind of pointing towards us maybe getting a little bit overextended. And at that point, I can set my trailing stops, start scaling out of the position. Again, I don't like to pile everything in one trade or pile everything out of one trade. If I dollar cost average into a position, I'm happy to dollar cost average out of the position as well. And the same is true for the downside. I mean, here we didn't actually get right down into this green zone here, but I actually use this on the 4-hour chart on my trading view. And once we get into these very good favorable risk reward opportunities where it looks very attractive, alongside some negative funding rates, alongside some terrible sentiment across social media, everyone calling for substantially lower lows. Once we see no large scale profit taking on chain, looking at something like the value days destroyed, all of these give me some indication that now, of course, there's still the potential for downside. Of course, I could enter and we go down 5-10%. But the odds seem to be a little bit more in my favor. So recently, as we went down to $74,000, $75,000, I was mainly scaling as we crossed beneath this, just around $80,000. Like I said, I didn't get in at the exact bottom, but I was happy to welcome the opportunity to scale in more aggressively as we spent a little bit more time down there than maybe many anticipated. And as we started coming up to 100K, again, we started getting some signals that the funding rates were starting to get a little bit more positive. We were starting to get a little bit overheated on this Crosby ratio, making new all-time highs. And again, all of this in confluence gave me some indication that now may be a good time to just start taking a little bit of profit out of this. So again, I like to almost operate like a Swiss Army knife and have tools that are usable across any data point, any chart, or anything like that. And I'm glad you're here. Glad to hear you're a fan. And yeah, I just love coding indicators like this, custom metrics, on-chain data points. This is the thing. I'm just a real nerd for this. I've been doing this for a few years, but honestly, if I couldn't do this tomorrow, if Bitcoin Magazine sacked me, I'd still be doing this just out of the love of it.
Yeah, that's amazing to have this passion for this. I completely share the same thing. And I wanted to mention that just on the slide that you were sharing, those 3 recent peaks that the ratio is showing, they have something that changed in the 3rd peak. If you can share again the screen.
Yeah, it should be sharing.
Okay, I got it. So if we look at the recent peak in the area in pink, then we look at the second one that happened around 105, I will say, and then going backwards, the next major peak is around 74K. So what I see is a big change, a substantial change in this behavior, is that from peak to peak, the peak going backwards, the third one, the one at 74 relative to the next one, had a breakout. That's what I was calling the megaphone pattern that we stayed in all 2024, and we broke out. And we broke out to a new range. So that second peak from the last one, going backwards, when we get into 105, is a new range, right? So it's a completely separate new range. But this new peak, the peak that we just formed when we exit the pink area, is not necessarily a new range. And that is a new anomaly that is showing the weakness in the current timing where we are. I have to say, I'm a little bit disappointed about the performance of this particular breakout, because it kind of de-inflated too quickly before actually breaking substantially higher. We got into 105 on the second peak, and in the most recent peak, we just got into 112, and we're back in the same range as before. So that is a completely different behavior, and it shows the bearish case, which I actually wanted to ask you a little bit about your bearish case. What are the things, excluding this comment that I just made, that you might think are valid sources of concern with the current cycle, and just even if they're not convincing you yet to sell or anything, but what would you say? Look into this.
Of course, yeah, that's a great way to conduct analysis, to force yourself to play devil's advocate, to say, if I had to come up with a bear case, how would I come up with this bear case? And one of them would be the correlation to the S&P 500 and the macroeconomic uncertainty we're seeing in the US, of course being so heavily correlated to the US economy, well, US stocks and equities and such. If we do see some continued conflict and we see the S&P 500 retrace substantially, Bitcoin is going to follow that. That almost certainly is going to happen. Alongside that, I do think, again, this is more of a long-term issue. The revenue discussion we discussed previously in terms of miner revenue, in terms of fees and the just network utilization, I think that could be something that becomes a little bit more of a long-term concern for Bitcoin as we grow as an asset class and as the block reward continues to diminish. And of course, just looking at it from a technical perspective, as we kind of show a very similar pattern to what we saw in 2021, where we have this double top formation, realistically, if we can't start making lower highs and higher highs, and higher lows from here, then from a technical perspective, the chart obviously doesn't look great. Now, of course, zooming out, I think it looks pretty good, and looking at the on-chain data and everything, as I said, I'm very much still following my bull case, but you have to take into consideration this. And another thing is just the lack of retail inflows. I mean, we haven't looked at the Google Trends search terms on this video, but I'm sure everyone's seen the charts. Not many people are really interested in Bitcoin. There's definitely the argument to be made that too many people have been in Bitcoin previously and got burnt and therefore just not as interested this cycle. And if suddenly Bitcoin is 100% reliant on these institutional, or I know we've been over this a few times, but let's just call it for the sake of argument, these institutional inflows into the market just to prop up and keep the market in equilibrium, at some point institutions going to get a little bit tired of pouring billions of dollars into the market to see very little returns and Bitcoin just stabilize because there's not enough external capital flows coming into the market. And of course, people that bought Bitcoin at $1 or $10, it makes sense to start taking some profit above $100,000. It's a nice round psychological number and it allows you to buy nice new house, nice new car, whatever it is you want. And yeah, I think all of those together, you can make the argument that there is, of course, still some downside to be had. But like I said, there's always some downside to be had. And if I put that weight of more downside and an end of the bull market at 10, 20% for a 50% retracement, but I put the upside at 60, 70, 80% and potentially 100% upside gains, then again, the returns are very much in my favor to take that long side bias in anticipation of higher prices.
And just to close up with the live stream, what would you say is a realistic cycle top range?
So everyone asks, and again, it's one of those where it's a boring answer, but it's better to be reactive than predictive. But again, that is a very boring one. But it is genuinely very difficult to predict. So I think as a bear case, $130,000, $140,000, $150,000 would be kind of my minimal expectation. I think if we don't reach that, then it'll be a somewhat disappointing cycle, let's be honest. We're all wanting much higher prices than that. My base case is somewhere around $170,000, $180,000. I think that aligns quite nicely with a lot of on-chain metrics, which we haven't discussed today. And then above that, there is probably around $220,000 to $240,000 would be my bull case. I really can't see us surpassing $250,000, but realistically, all of this goes out of the window if we do see Bitcoin strategic reserves. If we see game theory on a national level, we're seeing the US start piling in alongside other countries, And as well as that, if we look back to 2017, when we first surpassed $10,000, everyone said that, we're finally into five-figure territory. We must be nearing a peak now. A lot of metrics were starting to flash that we're getting a little bit overheated. And within 2 weeks, we doubled to $20,000. Now, in this cycle already, we've had 100% returns in very short spaces of time. I mean, if you looked at when Bitcoin was at around $30,000, at around tail end October, November of 2023. Was it March when we hit $74,000? So that's a very short space of time for Bitcoin to well over double, well over 100% returns. And then just before Bitcoin first ran up to $100,000, again around September, October time, I think it was, Bitcoin was at $50,000 and blink and you miss it a couple of months later, we're well above $100,000. So these are 100% returns in fairly short spaces of time. So Bitcoin very much could just have a more boring, more consolidationary period for the next few months. And before you know it, we're at 200K. And then at that point, it becomes very difficult to predict exactly the price. But as I said, I like to work in probabilities. I'd put probably 33% on each of them. But with each new day, with more data that comes in, with all of the uncertainty, of course, these change. So these are all moving targets.
And just one last question. Since you declare that you are still supportive of the 4-year cycles, so that does that mean that those numbers that you're giving of the bull case, the bear case, is within 2025, or you think that this could expand into 2026 early or beyond that?
So I think if you looked at the timing from cycle lows to cycle peak, looking at the two previous cycles, which are really startlingly close within just a few days of each other, I think that put us at some time in mid-October. I actually think just due to the seasonality we do see in Bitcoin, where we usually have a really strong Q4, maybe we do extend towards December or maybe even slightly early next year. But yeah, I think the 4-year cycle currently has to be my base case because that's what the data is currently supporting. And until that breaks, we're just guessing. So I would say Q4 2025, maybe extending into early 2026 would be my expectation from these prices could be met.
That's fantastic. It's been great having you today, Matt. Thank you for joining me today. And I'm sure that everybody is so pleased to have you. We need to schedule one for next month, definitely, to see how things are progressing as we come out from summer period, which tends to be also a season that is not necessarily the best always. And hoping to see you in the next time.
100%. It's always a pleasure and I'd love to come back. So thank you all very much for watching. And of course, thank you for having me.
Cheers. Thanks so much, everyone. See you in the next one. Bye-bye.
Cheers. Bye-bye.